In a couple of minutes while we wait for anyone a little late, so sit next and we will see. Good evening, everybody. Welcome to the webinar, Crude Palm Oil Price and Plantation Outlook in the second half of 2022. I'm Ming Hui from Phillip Nova, and speaking to us tonight will be Mr. David Ng. He is a full-time proprietary trader at IcebergX, and like the webinar title says, he will be sharing with us crude palm oil prices as well as the outlook for the plantation sector. Stay on as he shares his views on key stocks associated with the crude palm oil sector as well. Before I pass this on to David, please be reminded that if you have any questions throughout the course of the webinar, you can drop them into the questions box and we will address them during the live Q&A session towards the end. And now, without further ado, let's have David speak to us.
Hi, Ming Hui. Thank you, Ming Hui, for the introduction. Before I start, just a quick sound check. Are you able to hear me, and are you able to see my slides?
Yes, you sound great and we see the slides.
Okay, thank you very much. Yep. Firstly, I'd just like to thank Phillip Noah for inviting me to speak on this platform. I think entitled Crude Palm Oil Price and Plantation Outlook. I mean, if you have been trading the market, whether in the futures market in Bursa Malaysia, or whether you are involved in any of the stock markets that's involved in plantation, you do recognize that prices has been very volatile of late. We have seen the highs and pretty much we have seen quite a low just a couple of days back. So really, I think it's going to be a volatile period in the palm oil market, and it's not only restricted to the palm oil market. If you just look at general in commodities as well, it's been quite a challenging period. And if you are trading a space, it's going to present you a lot of opportunities going forward. So just before I start, as usual, with disclaimer, any views presented here or any recommendation are purely based on educational purpose. So dabbling with futures or even in stock markets does carry a certain amount of risk. So make sure you do speak to a licensed representative before you start engaging in any of these products. So purely my views here are purely my own basis, and it's purely for education. It doesn't represent any views by Phillip Noah or even by the exchange itself. Now, I think in today's webinar, I'm just going to touch on these few key points. I think firstly is that we have seen pretty much commodities in general has hit certain commodities has actually hit an all-time high. If you just look at palm oil itself, we have seen the high, the contracts as high as 7,000 to 8,000 ringgit per ton on Bursa Malaysia. So whether the price is going to sustain itself is going to be quite challenging as we go into the second half of this year. So definitely there's a couple of demand and supply dynamics is actually in play and is actually affecting the palm oil market. So if you are holding some plantation counters, so do make sure that as prices becomes volatile, do make sure you pay close attention to this some of these stocks that are holding, because eventually as prices starts to move, generally the prices of some of the key plantation stocks will also move to as well. Now, I mean, trading commodities itself is quite seasonal. If you just look at palm oil itself, there's always a period where palm oil tend to display a very strong seasonality pattern. Now, this mainly down to its key fundamentals, especially when it comes to supply and demand dynamics. There's always a period where market tend to be oversupplied, given the rising production and weaker demand. So therefore, prices tend to be on the downside. But vice versa, if you just look at certain periods, especially towards the later part of this year, we notice that prices of CPO tend to be stronger, given the fact that we have lower production as well as stronger demand. So seasonality does become an important tool if you are trading the market. So whether you are planning to invest in certain stocks, plantation stocks that you have in mind, do make sure that generally towards the later part of this year, we tend to see a bit of rally in some of the plantation counters. So I'm just going to share with you some of the key plantation counters that's in the Malaysia market that's listed on the Malaysia exchange. If you just look at the total Malaysia plantation index, we have total of close to 40 to 50 companies comprising whether it's small, medium, or large size. So going through all those is going to be a hassle, but I'm just going to share with you some of the top major plantation companies that's listed on the Malaysia exchange. Now, to give you a brief overview of where commodities right now, if you have been in the commodity space, you've just seen how the commodity prices actually been trading for the past 6 months. In fact, this year is a tremendous rally. I mean, it's not only restricted to crude oil, as well as pretty much the whole basket of commodities, with an exception of precious metal. Now, if you just look at palm oil, I think we hit an all-time high at about 8,000 back in early April. But since then, we have pretty much softened, and right now you're trading below 5,000 ringgit per ton. So that kind of volatility, I've not seen such a volatility before. So really, I think it's this kind of volatility. It does present a lot of opportunity, but if you are trading, you really make sure that you must ensure that you have proper stop loss measures in place, because you tend to get stopped out in the market quite often. So really, I think if you just look at the past couple of weeks, commodities in general has started to decline. I think given the fact that Federal Reserve has started to indicate the hike in interest rate cycle, so I think there's a lot of risk in the market. So commodities as a result took a toll, and you can see a lot of January outflow in commodity space. So nevertheless, I think palm oil to a certain extent is also affected by that as well. So just for the audience, if you are new to the palm oil space, palm oil is generally a very important commodity. Now, if you just look at the top producers in the world, Malaysia and Indonesia cover pretty much more than 50% of the global needs. So really, if you look at the palm oil market as a whole, really you have to look into Malaysia and Indonesia as a key supply to the palm oil market space. Now, some of the plantation companies, if you are planning to invest into it, you make sure that we have to understand the oil palm tree profile in terms of their age. So generally, if you have huge acreage that's their trees are mainly aged between 0 to 7 years. The first 7 years normally you classify them as young trees. So generally from 7 years onwards right until to the 20th year, generally those are classified as prime age. And generally the life cycle for oil palm tree is normally about 25 to 30 years. But with current technology and more research being done by some of the key plantation companies, they tend to extend their palm oil age. But generally, I think anything that's above 20 years, normally you start to see yields are starting to decline. So that's where some of the plantation companies will start to do replanting exercises. Now, palm oil is a very important commodity given the fact that it's a vegetable oil. So therefore, it's being used in so many of the key ingredients products that we have it on a daily basis. So obviously, there's a lot of campaign that's lobbying against the usage of palm oil, but we can't deny the fact that every important food ingredients that we take every day does involve a certain amount of palm oil that's being used. So palm oil is a major and important commodity. Now, these are some of the key factors, or rather news flow, that can actually affect palm oil prices. So I think this year we have seen how the Ukraine-Russia conflict has actually aggravated supplies of the key vegetable oil in the market. So therefore, it's actually benefits palm oil in certain ways. Crude oil price is definitely an important factor in terms of talking about palm oil prices, because this is in relation to biofuel. So if high oil prices will definitely encourage producers, or some of the key producers, to start turning into palm oil into energy space. And when you have high crude oil price environment, normally you see higher palm oil prices as well. Now, when it comes to any commodities, the key factors is always back to supply and demand. So whenever we have high supplies, normally prices will tend to be on the lower side. So I think this year's supply for Malaysia itself is actually quite quite unpredictable, given the fact that I think last year, Malaysia as an economy in general, we just started to come out from the lockdown. A lot of estates has been screaming that they have not enough supply of labor. And in fact, if you just look at fertilizer cost, is an important issue, because of the ongoing Ukraine-Russia conflict. Is actually aggravated the price of fertilizer. So therefore, I think it's actually restraining a lot of supplies that's coming out from some of the key estates. So really, I think Malaysia this year we should see lower supplies. But I think crucial to watch will be next couple of months as we enter into a key period in terms of palm oil supply. So as long as labor issues are being rectified, and I think the government is between Malaysia and Indonesia, they are doing a negotiation. So I think looks likely that the labor issue might resolve pretty soon, and hopefully supply will resume. But given the fact, I think a lot of expectation is that Malaysia probably will record a lower production this year compared to last year. But that remains to be seen. Hopefully, things will be better, and production will tend to resume towards the third or fourth quarter. Now, I think cost itself is escalating with higher fertilizer costs. Some of the plantation companies are feeling the brunt of it. So ongoing Ukraine-Russia conflict is hiking the cost for a lot of major producers. So even though we have seen high prices in terms of CPO prices, that does not translate into better margins, because your costs are also increasing. Fertilizer costs can usually range between 20 to 30% for a normal production cost in the plantation company. So that's quite substantial. So with fertilizer costs inching higher, I think that's going to put a lot of pressure for some plantation companies. So Indonesia policies, again, I think this is going to be a big impact. We have seen how it impacted palm oil prices. So news that Indonesia, just early part of May, or later part of April, we saw Indonesia government decided to restrict or ban the export of palm oil. In fact, you just look at how prices actually feel prices from climbing from 6,000 ringgit per ton to 7,000 ringgit per ton. So that's quite a substantial gain, and it's all down to policies. So if government decided to restrict any exports, that will really feel the market higher. But you just look at how policies can change. So Indonesia has actually reversed that policy. In fact, they have actually issued permits to export palm oil into other countries. So I've seen how prices actually collapse from 6,000 ringgit to right now where we are is about 4,500 ringgit per ton. So policies are very crucial, and going forward, it's going to create a lot of volatility in the market. So as long as we don't have stable policies, market will tend to gyrate whenever there's policy announcements. Now, there's another important key factor whenever you look at the palm oil market is to look into other vegetable oil market as well. I think one of the key important market that worth watching whenever we talk about palm oil is always the soybean oil market. So given the fact that both are vegetable oils market, and it does correlate quite positively with each other. So whenever you have high palm oil prices, normally you tend to see higher soybean oil prices. So I think just a couple of days back, we saw soybean oil took a big correction. So therefore, I think that also impact on how CPO prices is going to go forward as well. So just to show you a chart on the past 30 years of how CPO prices has been faring in versus Malaysia. So if you just look at back in the early 1990s, prices were trading about 1,000 to 1,900 ringgit per ton, and it stayed there for pretty much the later part of the decade. As we enter into early part of 20th century, we saw that really the prices tend to adjust on the higher end, trading between 2,000 to 3,000, and trading as high as 4,000 back in before the financial crisis. Then thereafter, once GFC hit us, prices were trading back into the 2,000 ringgit per ton range again. Now, what's crucial is that we finally broke that long-term over 15 years of range trading. We finally broke out that price range, and in fact, we are trading way above the 4,000, 5,000 ringgit per ton, and it actually went to as high as close to 7,200 ringgit per ton. That's the peak. So really, I think we are definitely in a different cycle in terms of palm oil prices. So what causing that rally really, I think, is down to supply and demand, and really we are watching that the supply is actually quite tight. Demand is still very aggressive, and obviously pandemic has shifted some of the key supply dynamics as well. Just to give you an update on the palm oil sector as a whole. Now, the reason I said earlier, why we should watch out in terms of seasonality pattern in CPO market is because if you notice the production trend in the palm oil space is that normally around the start of May, June period, usually you start to see production tend to pick up. This is seasonal, and it has been ongoing for the past 10 to 15 years. So obviously there's a lot of factors that can change this. Normally weather is one, fertilizer application can be one. But generally, if you just look at the normal trend, around May and June is where the start of the rising production. And if you just look at the pattern itself, normally the production will tend to rise right until pretty much the early part of October. That's where the peak of production happens. So once you pass October and you enter into November, December, which is pretty much the end of the year, normally production tend to taper off. So really, I think if you just look at the pattern itself, we are entering into a high production period in terms of the CPO market. Now, obviously, there's factors that can affect it. Like I mentioned earlier on, one of it is definitely on the supply of labor. The supply of labor is not being resumed. Obviously, going to be restraining some of the supplies that's going to come into the market. So there's obviously other issues. Weather can be an important play, but given the fact that these variables doesn't involve that much, then pretty much we should assume or we should expect production pattern to remain quite the same as years goes by. So pretty much you will see that beginning of April and May is the start of a rising production, and around September, October usually is a peak in production period. Now, I think one of the key determinants in terms of prices is to look into stock levels. So beside production, it's important for us to gauge the stock level for the CPO market. So the reason why we are seeing such a high prices right now is that you just look at the stock level in Malaysia itself. For the past decade or so, we have been trading way above the 2 million tons stock levels for quite a long time. So I think just in 2021 and 2022, this year itself, we saw the levels actually fall below 2 million metric ton. Now, with stock levels that's quite low, normally prices will tend to be quite supportive, and vice versa. If stock levels starts to inch above the 2 million metric ton, normally that foretells you that the price will have to adjust downwards. So right now, despite we are seeing a correction in prices, stock levels in the country are still relatively low, but things can change. As I highlighted in the slides before, production is rising, so that could put a lot of pressure in terms of stock levels. So again, you just look at pattern itself. Normally June, July, August, with rising production, stock levels will also tend to rise in tandem. So that's where we have to watch out. If you are thinking you have not invest in plantation stocks and you want to dabble into some of the plantation counters, to make sure that you are entering into a weak period in terms of CPO prices. So generally, I think plantation stocks will tend to be on the downside as well. So do pick your periods well, and make sure you you pick the periods as in line with stronger periods in terms of prices, where you tend to coincide with lower production periods. Now, talking on a demand perspective, if you just look at Malaysia palm oil demand, this year has been quite sluggish as compared to last year. Now, in the palm oil space, the two biggest buyers is always China and India for Malaysia palm. Obviously, we'll compete with Indonesia, in terms of exporting the Malaysia palm. So it was a good news when Indonesia decided to restrict, their exports of palm. In fact, I think if you just look at last month, we have recorded higher destination to both China and India, because I think with Indonesia banning their exports, that gives us a lot of leeway for Malaysia exporters to catch up. But that has changed. I think Indonesia has reversed that ban, and in fact now they have issued a lot of export permits out. So that really clear and flush the market with additional supply. So that gives a lot of competition for Malaysia exports. So that I think therefore prices of CPO tend to adjusted pretty much, I think, a couple of days back, as a result of this onslaught of supply that's coming to the market, especially from the Indonesia producers. But really, I think the trend that we have to see is that as long as India and China are not aggressively buying, normally the demand tend to be quite sluggish. China, one thing to watch out is the ongoing lockdowns. Maintaining COVID-0 policy is very strict, and it's going to have a big impact in terms of their demand. So as long as China is adhering to the zero COVID policy, I think that's and with ongoing lockdowns, that's going to have an impact in terms of the palm oil demand. So do watch out. If demand tend to be sluggish when you have rising production, normally stock levels go up, and that will tell you that prices will tend to be trading on the downside. So now I think the better part of it is that if you just look at just a couple of months back, China and India did record a stronger import this year compared to the year before. And in fact, if you just look at the average itself, it's actually higher than average. But the key question is that in the next couple of months or so is to see how the trend is going to be faring. As long as the trend doesn't really change as much, we should see demand still quite supportive. But if it does change, I think pretty much we should see a sluggish demand overall for Malaysia exports this year. Now, one important point to take note is that despite the performance, or rather despite the export demand to India and China is actually quite lackluster. But if you just look at their stock levels at their port, that tells you a different story. If you just look at China itself, even though they demand less of palm oil, but palm oil stocks at their port is actually quite low at the point in time. So this goes to tell you that they're bound to be a time where they need to restock, and it's just a matter of time. So when that does happen, China will aggressively start to buy in the market again. There's a couple of reasons for it. One could be because if you just look at prices for the past 2 or 3 months back, the prices in BMD was trading about 7,000 to 6,000 to 7,000 ringgit per ton. Is relatively very expensive. So China being a very sensitive buyer, normally they will hold on to their purchases until prices have a steep correction. Then probably they'll re-enter the market again. So stock levels are low, so that gives a positive sign. It's just a matter of time where China will come into the market again and start buying back again to restock their palm oil stocks. So whether it's crucial next couple of weeks, whether should we see any sign of China stepping up their purchases? If that's so, then likely prices will tend to be supportive. Now, if we just look at the average yearly CPO price, if you just look at it back in early 2000, we saw the average price trading about within the range of 1,000 to 2,000 ringgit per ton. So that has changed. If you just look at the early part of 2010 onwards, I think the average price of CPO has actually risen to as high as 2,500 ringgit per ton. These are all yearly average, and obviously these 2 years itself, we have seen a tremendous rally. I think really we are talking about this year average CPO price could be falling between 5,000 to 5,500 ringgit per ton, which is quite substantial. So any plantation companies or any companies that's involved in the plantation sector, you definitely gain from these price increases. But then again, the formula, pretty much, if you are producing the commodity itself, and if volume is not increasing despite price is rising, that does not translate into gains in a particular company. So I think that's worth to pay attention to. Later on, I'll just be sharing you some few case studies that you can probably look at on your own as well. So this is just what I highlighted earlier. These are some of the key policy changes that's instituted by the Indonesian government. So the thing is that prices are very sensitive to decision by the government. So anything that the government decided to instate a ban, or we start to see prices tend to gyrate. So really, I think going forward, this is an area of uncertainty. And if you are trading the space, do watch out any developments that's coming from Indonesia side regarding their policies, because that will have an impact in the market. So right now, I think Indonesia is aggressively trying to flush out their excess supply. So that I think that is pressuring prices, even lower. So if you just look at the 20 years price seasonality, now if you just look at from January to December itself for the past 20 years, and you notice that one thing is very clear. December usually is a very strong period for CPO. Given the fact that if you just look at production itself, November, December tend to be the period where production start to taper off. Demand tend to be stronger as well, because year-end festivities, the demand tend to be generally be stronger. So therefore, I think prices will tend to be showing you more positive. Now, what is worth to pay attention is that if you just look at periods where it's quite bad for CPO prices, normally it's around June to August period. In fact, June is quite a volatile period for CPO for the past 20 years. In fact, I think this year, June month itself, I think the price range for monthly prices, it ranged about 20%, which is quite substantial. I think it's highest in the past 20 years. So really, it goes to tell you is that we are entering the period where prices tend to be more volatile, and it's actually on a weaker pace, because if you just look at the key fundamental developments, you're definitely going into a period of higher production and weaker demand. So therefore, I think that's quite in line with some of the fundamental seasonality pattern. So do watch out. If you are trading the space, if you are planning to invest in some plantation counters, do pick your time well. These are the periods where plantations companies tend to perform relatively weaker as compared to other sectors. Now, I just want to share with you a comparison between another vegetable oil, between soybean oil to palm oil spread. Now, I think for those who are trading the futures market, they tend to follow the spread quite closely. So whenever we have a high soybean oil to palm oil spread between the range of say 200 to 600 US dollar per ton, normally that entails you that soybean oil is trading at a very steep premium compared to palm oil. So it goes to show you as well that palm oil is actually quite attractive whenever the premium goes into deep positive premium. So again, I think right now we are heading back to the 600 or even in fact to the 500 ringgit US dollar per ton range. So it goes to tell you that the soybean oil market looks like a bit more expensive, and the palm oil market looks to be a bit more attractive. So really going forward, on a relative basis, it shows that palm oil does have a bit more room on the upside. So really, I think the current market that we're seeing, the current selling that we're seeing in the palm oil market is pretty much overdone. So eventually the market will tend to see a bit of short-term rally in this space. But again, I think this is on historical comparison. Whether this spread will eventually reach to as high as 600, it may, or whether you'll revert back to its average about 150 or 200 ringgit, 200 US dollar per ton. So that's really a question that we have to wait and see. But eventually, I think when you have high premium market, like what we are seeing right now, normally is a sign or indication that palm oil market is actually quite oversold at this point in time. So moving into stocks, if you just look at the stocks that's listed on Bursa Malaysia, there's plenty. In fact, I think there's a total of 50 to 60 companies. So really to segregate them, it's best that we categorize them into two types. Whether one is, because if you just look at the palm oil industry itself, it's broken down into the upstream and downstream segments of the industry. So upstream segments of the market or the industry always it foretells that the company is involved in the commodity itself. Normally they will own plantation, and normally they will hire workers or laborers to carry those fruits, and normally they have the mills to press the fruits into and turn it into oil and further sent to refinery to further refine. So normally upstreams are players that always involved in a plantation itself. They generally have mills, but some plantation companies may not have refineries because due to their sheer size, generally refineries to create a refineries or to set up a refinery, you does involve a lot of heavy capital investment. So if you are a small plantation company, normally it won't involve in the refinery because it's not scalable enough, or rather, it's quite capital intensive. So certain companies are actually quite focusing on the upstream segment of the market. Now, obviously, the whole value chain of it is that we have the upstream and the downstream segment. So certain companies are quite involved, pretty much in both the segments. If you just take for example like IOI or KLK that's listed on Bursa Malaysia, pretty much they are considered as an integrated palm oil company because they are comprises both the upstream segments as well as the downstream segments. So downstream segments are actually quite relating to the oleochemical side. So Jenny, if you just look at the first picture I showed you on the first part of the webinar, if you just look at the products that's involved in the palm oil as a commodity, Jenny, you look at your soaps, your detergents, it does involve a lot of oleochemical. So companies that is quite integrated, they involve the whole value chain of the whole palm oil industry. So really, I think it's quite a well diverse value chain across the board. So really, there's only selected few integrated companies that's listed on the Bursa Malaysia. So just to show you an example of the listed companies that's on the Bursa Malaysia. So I think there's roughly about 40 to 50 companies on the index itself. Every year there will be certain companies that's taken private. There's certain years there will be a new IPO for certain plantation companies. So the index itself will keep updating on the constituents respectively. Now, if we compare the plantation index against the plantation stocks, individual stocks, not all will fare or not all will move in tandem. Now, if you just compare the big guys, or rather the bigger market cap for certain plantation companies like KLK, IOI, or even Sime Darby Plantation, these are considered the big plantation companies. If you compare the price performance with the index itself, generally the index, generally these companies perform quite relatively stable. They don't move much, and if they see the market generally moving 5%, normally they move in the region between 2 to 3%. Now, if you compare the other type of markets or the other type of plantation companies that's only focusing on upstream segments of the market, like Boosted Plantation or even TSH or even SOP, these companies are very young in their H3 profile, and they're very focused on the upstream industry. So they tend to gyrate a lot when it comes to palm oil prices. So it really depends on your risk preference. If you're intending to invest in companies that's quite integrated, pretty much companies that's involved in the whole value chain, then bigger cap companies like IOI, KLK will fit the bill. But you tend to if you want to capture the price swing, or companies that move in parallel with CPO prices, then I think SOP or TSH or even Boosted Plantation, these are companies that's very focused on upstream industry. So therefore, their prices tend to gyrate quite in line with the palm oil prices. So if you just look at it, I think itself, the plantation index, the funny thing is that when CPO prices plunge or move a lot, you don't see plantation companies to move as much. Reason being is because plantation companies, their earnings will only reflect the next quarter or the next subsequent quarter. It doesn't reflect immediately. But generally, when a strong uptrend is in the market, plantation sectors will normally be beneficial. But then again, it's always considered as a laggard, given the fact that commodity will always be reflecting the price immediately, and stock companies or plantation companies will take some time for their earnings to be reflecting, for their profits to be reflected in their stock prices. Just to show you some relevance, if you just look at CPO prices back in March, where we saw an intraday limit high for the CPO price, and if you compare some of the performance of certain plantation companies, you can clearly see that not all companies will perform as what the market is. If you just look at RI and United Plantation on that day, I think they recorded down. If you look at others plantation companies, they actually recorded higher performance. And again, the quantum is also slightly different. So generally, if you are a smaller plantation company and you're focused more on the upstream segment, generally you are more in line with CPO prices. If you just look at 2 days back when you saw almost limit down price in CPO market, again we saw the performance tend to be mixed. The funny thing is that I think when the CPO was down by 10%, generally the big cap companies or the bigger plantation companies like your KLK or your SIME, which is more integrated, I think they suffered even more losses compared to other companies that's only focusing on the upstream segments. Again, I think this is because SIME, KLK, and RI, they are also constituents in your major KLCI index. So whenever there's selling pressure across the index itself, these companies will get affected first. So I think that's another consideration whenever you look into these plantation companies. Now, I think one of the key metrics when it comes to looking into plantation companies is look into the FFBU. I think that's one of the important metrics to consider. If you are comparing to different companies, one of the metrics that we always use is to compare their yields level. So if you just look at some of the plantation companies that's listed here, really, I think the higher yields are like United Plantation. It's considered a very efficient plantation company. Even TSH is considered very good because TSH has its own R&D. They research on their own seeds, so therefore they yield higher percentage as compared to other plantation companies. KLK, LI, they fare pretty well as well. Now, if you just look at FGV and Booster Plantation, generally their yields level are on the lower end. Now, one thing to highlight is that I think 2021 or last year, if you just look at yield across the board, I think generally some companies actually suffered lower yield compared to compared to years before. Reason being is because I think last year we suffered labor shortages, so therefore it actually impact the yield quite substantially. But if you just look at it as a matrix of comparison, I think United Plantation, KLK, LI, TSH, these are companies that generally their yield levels are actually pretty on the high end. FGV and Booster Plantations, their yield levels are generally quite low. There's a couple of reasons for it. One thing is the H3 profile. If you just look at FGV itself, the H3 profile on average is generally about more than 20 years. So their yield levels tend to be a bit low. So therefore, it actually require a lot of replanting exercises to increase the overall yield again. So whenever you're looking into companies, I think comparing their yield levels is important to make sure that you're selecting a company that is a higher yield profile. So therefore, it's actually more efficient. Now, some of the plantation stats. The reason I chose some of these companies out of this 40 or 50 list is because these are the companies that, if you filter it, is actually more than 1 billion ringgit in market cap. So if you compare, if you rank them by market cap, SIME Plantation always is at the top. KLK, LI always fight for the second place. Depends on what's the share price that's being done at that point in time. And followed by Genting Plantation, United Plantation, FGV, SOP, Booster Plantation, and last but not least TSH. And we just look at the land bank itself. SIME has a very huge land bank. if you just look at the history of Sandali Plantation, it has been doing a lot of mergers. So therefore, I think the land bank itself is quite substantial. But not all the land banks are being planted. There's only certain amount of the land bank is being planted at this point in time. So given the fact that they are the largest plantation company in terms of land bank, their yield levels are not surprisingly quite good. So I think that's something for us to consider. So even though you have the biggest land bank, doesn't mean that you have the highest yield or the most efficient plantation company. If you just look at KLK and RI, which is quite, they have a huge land bank. If you just look at the yield levels are actually quite good. So it's also, these are the few companies that are actually worth to consider as well. Genting Plantation, they also have quite a huge land bank. So again, I think the yield levels are also quite pretty much on the low end. I think for the fact that some of the estates are pretty much small estates. So whenever you have small estates, it's quite hard to manage. So the yield levels tend to fluctuate. So I think that's also one of the reasons why having large land bank when you're broken up to small estates, that's actually quite difficult to manage. So that's a case, for example, for FGV. So FGV itself, this company itself has a huge land bank, but it comprises a lot of small estate holders. So normally estate holders, they tend not to have efficient, planting practices. So therefore, their yield levels tend to be on the low end. So I think this is a problem for FGV as besetting them since the day that they've been listed on the exchange. So I think really, even though their share price performance are quite moving in tandem with CPO prices, but if you talk about growth prospects and the future for the company, really it's going to be a tough one because the land banks comprises a lot of small estate holders, which can make the yield quite suppressed in the longer run. Now, in terms of financial matrix, there's a lot of financial matrix as you can use to filter out. But what I use here is just look into the PE ratio and the return on equity as well as dividend yield. So again, I think if you look at the profile of it in terms of PE ratio, SandW and KLK doesn't seem to be that expensive. It's still quite relatively cheap. RI seems to be a bit more expensive. And I think RI itself, compared to other plantation companies, is in terms of PE ratio itself is one of the highest. I think given the fact that their earnings are not coming in as what the market expected, so therefore I think it's priced slightly more expensive. Now in terms of return on equity, I think one of the most sustainable one is still KLK. Now FGV, if you just look at the table itself, FGV and Busa Plantation, they recorded a very high ROE. Reason being is because they have for Busa Plantation, they have actually sell some of the key businesses. I think they realized their gain back in 2021, so therefore the ROE actually increased sharply. But if you look at the trend itself, these are all exceptional gains, which should be taken off. So I think generally the most stable companies, their return on equity generally fare about 14 to 15%, which is quite good. KLK is slightly on the higher end. So in terms of dividend yield, again, generally most companies will give you between 3 to 4%, which is quite good. You can't compare to other sectors, but as a plantation company, it's fairly good. Exception here is that Busa Plantation, they did realize of a business entity, so therefore there's a substantial gain, and they pay out a special bonus. Now, in terms of gearing risk and liquidity, if you just look at it, United Plantation is a very well-run company. Generally, is well. The cash power is huge. The current ratios are very good. The debt ratios are very low. So generally, I think United Plantation is a very well-run company. If you just look at yield itself, it's actually one of the highest in the industry. If you just look at others like KLK and LI, again, I think the metrics are very similar. The current ratios are very similar. The debt ratios are also equally very similar in the sense. SandW, in terms of their cash ratios, are a bit on the lower end. So debts are also quite well controlled. With exception of companies like FGV, even though they have strong cash reserve, but the debt levels are very high. So I think that's something to watch out for whenever you look into these companies. So plantation companies, usually will try to dwindle down their debt. It normally take years because the loans that they take are quite substantial. And with rising interest rate environment, if you have a high debt to equity ratio, I think that's something for us to really pay close attention to. So those companies that have low debt to equity ratio, I think that's worth to consider. Because generally, I think that in this kind of environment, when you have rising rate environment, and when you have high debt ratio, that will put a lot of pressure on your earnings. So I think that's one worth to consider. Companies that actually have low debt to equity ratio. Now, so that's some of the key financial metrics to really filter out some of the key plantation companies. So I think looking at market cap, looking at PE ratio, looking at debt ratio, I think these are all important parameters for us to really gauge on how the performance of a particular stocks will perform, especially going forward. Now, coupled with that, I think it's important for us to use certain technical tools in order for us to gain entry and exit of a particular stocks based on a particular price. So I think one of the ways is to look at the trend. If the overall trend of the market, be it in the CPO price or be it in the stock itself, is on an uptrend, it's a good position for you to find entries for you to enter into the market. If it's in a downtrend, if you are not able to short the market, then you should not be participating or you should not be investing in a particular stocks. So generally, if prices are trading above the 200 period EMA, it foretells you that the prices of the market is going to be on an uptrend and vice versa. So the 200 period EMA is one good way for you to distinguish whether the trend of the market is on an uptrend or a downtrend. So ready to pinpoint exact entry and exit. So we always couple with that with a 9 period EMA and 20 period EMA. So we use a moving average crossover. So as long as a bullish crossover on a moving average, that will tell you that's a good point of entry. So if it's a bullish crossover, that tells you the 9 period EMA is crossing above the 20 period EMA. That will be a potential good entry for you to long the market or to be entering into a particular stocks. Now, I'm quite a big fan of Heikin Ashi, and as compared to using Japanese candlesticks. Now, Heikin Ashi in a way can tell you the trend quite clearly. So if the trend is trading on an uptrend, normally you see a strong green candle bar. So it's actually showing you a much clearer signal as compared to using a Japanese candlesticks. So again, if you are trading, these are all part of the setup of trend trading. So if the trend is up, you should be taking position for you to taking a long position in the market. If the trend is down, you should be taking position to be exiting the market. If you can able to short the market, you should be shorting the particular market. Now, you can obviously use support and resistance, which is very crucial. Later on, I will show you some of the technical stocks that show a very strong support and resistance level. There's particular stocks that always has a strong support and resistance level. Once you break that kind of level, normally it will be quite a big move on upward or downward. Now we can couple with that with some ADX indicator, which is also another trend strength indicator. So normally if the trend is strong, is usually reflected in the ADX. Volume, whenever you're trading stocks, volume is a very key component. So if the stocks has been trading on a sideway, you really need volume to come in order for market participants to push the price higher or lower. So volume is always important analysis whenever you look into a particular stocks. So just to show you, I think this is on Sime Darby Plantation. You just look at it, I think it has been recording highest net profit. The revenue has been rising. This is all in line with higher CPO prices. Now, if you just look at the technical charting aspect of Sime Plantation, I think really the 4 ringgit has been really a crucial support level for pretty much a long time. So if you just look at the technical tools I mentioned, I think firstly is to look into the 200 period EMA, which is the red line. So as long as prices are trading above the line, normally tells you that the trend is usually on an uptrend. But if prices are trading below, that tells you that the market generally is trading on a downtrend. So right now, if you just look at Sime Darby Plantation itself, based on technical perspective, looks like prices are trading on a downtrend. So crucial to watch if you are looking for entry signals, whether you test the 4 ringgit as a support that will be a crucial signal to take. If it does break, you should wait for a while before you decide to enter into this particular stock, because the 4 ringgit has been shown as a very strong support level. If it does break that normally tells you that generally the market is not favoring this counter at this point in time. I'm just not going to touch too much on some of the growth prospect, but I think IcebergX Bhd itself, being a very large plantation company and quite integrated, it has a story to tell. And I think one thing to take note is that they were actually being sanctioned, I think just last year, by US Custom, because there's issue on their labor, but I think that's being addressed. So I think going forward, some of the plantation companies, especially the larger ones, is going to be more prone to getting this kind of risk of being sanctioned by the US government, because when it comes to labor rights and labor issues, certain plantation companies does not really observe, and I think therefore that's going to be a key risk whenever you look into the plantation sector. So I think IcebergX Bhd has actually resolved it, so therefore I think the prospect looks to be quite good going forward. Now KLK is another company, is also quite integrated. So it's very similar to IcebergX Bhd in terms of their business structure. So I'm not going to go too deep on it. Now, in terms of their financial metrics, again, I think they recorded the highest net profit in their history since their listing, and their earnings per share was actually quite good. So it's all reflected in the price. So really, I think it's quite a well-run company. If you just look at the profile, the earnings per share, I think there's only one particular year in 2018 where they recorded negative earnings. But other than that, throughout the whole 10 to 15 years they're listed, they're pretty much recording profit all year round. In terms of their H3 profile, again, I think it's quite. They have a huge land bank. A lot of their big percentage of their planted areas are the tree profile is actually quite prime. So that tells you that at least their yields are still quite favorable, at least for the foreseeable years. Now, in terms of starting price itself, you just look at it. The key support levels for KLK is pretty much around $21. If it does break that, I think that will show further downside. Right now, if you just look at the long-term trend of KLK, again, it's actually it broke the 200 period EMA just a couple of days back, and really it's going to test the 21 ringgit level. If it does break that, I think there's further downside for KLK. But 21 ringgit seems to hold very well for the past couple of years. So do watch out. If it does rebound from that support level, that will be a very good entry for you to look at. Now, ROI perspective, again, I think majority of some of the key plantation companies, they've actually been trading below the 200 period EMA. That telling you that there's actually further downside for the particular stocks. So ROI is also a clear example. It's actually trading below the 200 period EMA, signaling you further downside. I think the key support level is around 380 to 370. If it does break that, really you're looking about $3, which is quite unlikely, given that the valuations become quite attractive. But ROI in terms of their PE valuation is one of the highest in the industry. So I think that's something for you to be worth to consider as well whenever you want to enter into this particular stock. Now, SOP, Sarawak Oil Palm is slightly to have a younger profile. And if you just look at the stock performance itself, it tends to perform very well, or moving in quite in tandem with CPO prices. But again, it's also trading below the 200 period EMA. It's also telling you there's further downside for this particular counter. So really, I think if the support level is about 350, and this 350 has been holding well since back in the pre-pandemic days. So really, I think if it does break the 350, you're looking at further downside. So that's worth to watch out for. If 350 does hold, I think that will be a very good entry for you to be looking at these particular stocks. United Plantation, the same thing. I think United Plantation, it has been quite sluggish in terms of their trading performance. Reason being is because it's quite a heavyweight counter in terms of prices. It's trading about 17. Right now, it's trading about 14 ringgit. The volume itself is actually quite thin. So, generally people favor highly more liquid stocks. like SOP or even FGV to a certain extent, or even IOI. But nevertheless, if you just look at United Plantation, itself, the fundamentals are actually quite strong. They have a very strong balance sheet, they have very strong cash position. I think that will weather them in terms of whenever you encounter high interest rate environment. So really, I think if you just look at technical perspective, still see a bit of a downtrend, and that's crucial to watch. The 1350 is a very strong support level. If it does hold there, I think that will be quite a good position for you to look at possible entry. FGV. Now, FGV, since the heydays, it was listed at around $5. It went as low as almost 60 cents. Then from then it recovered. Right now, the company is going to restructuring. In fact, I think they have actually tried to tone down their debt level. So with that recovery in play and with the kind of team, the prospect looks to be, seems to be the light at the end of the tunnel. But again, I think pretty much the whole industry is being affected by the sudden, steepness plunge in the CPO prices. So I think FGV in certain extent is also trading below the longer term moving average. So do watch out. I think the 150 is the immediate support. If it does hold, I think that's where it will be a very good entry for you to look at this particular counter. Now, the reason I like to highlight FGV is because even though the prospects are good, you just look at earnings, they're starting to improve. I think back in 2018, they've actually restructured their whole books. They start to dispose of assets that they are not giving much of earnings. And I think the recovery is actually quite in play. But if you just look at their gearing ratio, which is their debt ratio, is actually quite high. I think that's a very important consideration whenever you are looking into FGV. So just another last bit of one plantation counter, Boasted Plantation. So again, I think the chart is very similar. Support level is around 70 cents. I think that's where we really need to watch out for. If it does hold, I think that will be a good entry position. Now, TSH, if you compare to the rest of other charts, TSH seems to be a bit more extended. Now it's really testing the crucial support level about 110. In fact, $1 is a psychological support. If it does break that, that tells you that pretty much the market is actually quite bearish, generally for plantation companies. But seems to be, I think today, it's holding way above the $1.10 level. I think that's a very crucial support level to watch out for. So TSH is slightly overdone, in my opinion. I think that's worth to pay attention to as well. If the 110 continue to be a very strong support level, I think that's going to give a bit more possible entries in near future. So coming to conclusion, I think if you just look at most of the plantation companies, there's actually retraced back from the recent rally. Now the key question is that whether will we retrace the whole of the rally that we've seen in the whole CPO prices. Now, if you just look at fundamental itself, even though you are in a big production period, you are rising production period, stock levels are going to start rising. Prices tend to be a bit more on the downside. But I think if you just look at totality basis, if you compare to the year before, or even in fact into pre-pandemic, we are still quite comfortable position. Stock levels are still quite low, and I think the team is as long as the Ukraine-Russia conflict is still ongoing, the world is still short of vegetable oil. Palm oil is definitely going to be there to fulfill that kind of supply. So really, I think going forward, especially towards the fourth quarter, price will start to recover. Hoping that production will probably taper off and demand will start coming back again. So I think it looks like price may retest the 5,000 level again. And I think when you look into plantation companies, try to pick companies that have higher yield in terms of their fresh fruit bunch yield and stronger cash flow. Because when you have companies that's heavy in debt and you have higher interest rate environment, that will really compress earnings, and that will really translate into lower price performance. So whenever there's an up cycle or there's rally in CPO prices, and you want to get engaged in the plantation company, try to choose companies that have higher yield and a stronger cash position. Now, obviously, I think other than that, key important considerations to look into the tree profile. So like shown earlier, some companies have younger trees, and those companies that's focusing on upstream segments of the market, they tend to be more volatile. So if you choose to companies that you want to involve in the lower risk plantation companies, choose companies that's more integrated, which means they cover both the upstream and downstream segments. So you have the likes of Sine Darby or KLK or RI. These companies can withstand more of the price fluctuation. Now, labor issues and fertilizer costs is definitely going to be a very persistent issue, and it's going to affect pretty much the whole year. I think this is going to have a bit of it's going to have an impact on supply for this year as well. Demand side, I think as long as China is still maintaining the strict COVID-0 policy, I think that will pretty much wreak havoc for demand for palm oil. And if in case if they reverse that policy, if China start to open up their economy, starts to open up their major cities, I think demand will start to resume, and therefore I think prices will tend to have a bit of strength and support. So with that, I think we're going to go into Q&A. I'm just going to pause here for a minute for any questions. You can post it in the question box, and I will just address it momentarily. Okay, so I'm just starting to see the questions coming. Okay, the first question is, what's the all-in cost of CPO after tax per ton? Now, really, I think the CPO, the all-in cost of CPO, it varies between different companies. If you look at some of the bigger companies, they can absorb the cost better. So if you just look at the likes of KLK or RI, their cost level are within the region of 1,900 to 2,500 ringgit per ton. Some companies who are a bit more not that efficient, they tend to have an all-in cost roughly about 2,500, 2,800. Some even have cost level up to 3,000. So really, I think the margins are being squeezed. As I highlighted earlier, as fertilizer costs start to increase, I think that's going to put a lot of pressure, in terms of margins for some of the plantation companies. Okay, second question is, how much Indonesia palm oil exportable this 1-2 month period? Now, this is a very good question. Indonesia, after they have actually relaxed on the export ban, I think the major reason they relaxed on the export ban is because the whole market is flush with so much of the supply, and there's not much storage left in order for them to store all this palm oil, and as a result, they have to release the palm oil stocks. So really, I think if you just look at the numbers today that's reported by GAPKI, their Indonesia board that's responsible for the plantation sector, I think really the stock levels are still relatively very high. Whether I don't think foreseeable for the next 1 month, 2 months they can clear those stocks. So I think Indonesia, if they had the opportunity, they would try to clear as much as they can before their stock level starts to decline, and I think that's what they want, and that normally will take more than a month or two. So really, I think going forward really is how strong the demand is, and how much of a supply that they can pretty much flush the market with. So okay, I'm just going to take this last question. The question is from the audience. What's your view on palm oil stock that's listed in SGX, and does your conclusion key points also apply in those SGX stocks? Now, there's not many plantation companies in SGX listed on the SGX company exchange. I think some of the key ones are like Wilmar. Again, I think Wilmar is very integrated. Now, if you want to play the commodity team, Wilmar itself is actually quite a good benchmark. Again, I think it boils down to fundamental. Wilmar itself is quite well diverse. So we are rising commodity price, with rising palm oil prices, they tend to benefit because again they are across the whole value chain as well. So I think UMA is quite a good company to study with. Again, I think my focus was actually mainly, today's presentation is mainly on the Malaysian companies. So I think for the SGX point of view, I think UMA is a very good consideration. So with that, I'm just going to end here. I'm just going to hand it over to Ming Hui. If anything that I missed out. So Ming Hui, over to you.
All right, thank you, David. We have received an overwhelming number of questions tonight, and since time is almost up, we will answer the rest via email. And to our audience, if you have any further questions for David, you can send them to us through the CV that will appear once this session closes, and we will get back to you via email. And yeah, this was a very insightful session. So thank you again, David. And thank you very much, everybody, for your time tuning into this webinar tonight. We will be sending everyone a link to today's webinar recording so you can watch it again if you'd like to. And yeah, that's all for today. Thank you, everyone, and goodbye.
Thank you.